One simple investment decision in January 2026 could have either made you 32% returns or left you with barely 8% gains. The difference? Whether you chose growth stocks or value stocks. Most investors have no idea which category their stocks actually fall into. And that ignorance is costing them thousands of dollars every single year. Today, I'm breaking down the 7 critical differences between growth and value stocks. By the end of this video, you'll know exactly which ones belong in your portfolio right now. Because in 2026, the old rules completely changed. What worked for the past 20 years might actually destroy your returns going forward. Let's start with what growth stocks actually are. These are companies reinvesting every dollar back into expansion instead of paying you dividends. Think of companies like Tesla in 2026, which finally hit that trillion-dollar valuation, or the artificial intelligence companies that tripled this year alone. These stocks trade at high price-to-earnings ratios, sometimes 50 times earnings, sometimes 100 times. Sometimes they have no earnings at all yet. Investors buy growth stocks betting on the future. They're paying a premium today for profits that might arrive 5 or 10 years from now. The magic happens through revenue growth. These companies are expanding sales by 30, 50, even 100% year over year. When interest rates dropped again in early 2026, growth stocks absolutely exploded. Lower rates make future earnings more valuable in today's dollars. But here's the catch. Growth stocks are volatile. A single disappointing earnings report can tank the stock 20% in one day. Now let's talk value stocks. These are the complete opposite. Mature companies with steady profits, selling at bargain prices compared to their actual worth. We're talking about banks, energy companies, healthcare giants, businesses that have been around for decades and print cash every single quarter. Value stocks trade at low price-to-earnings ratios, maybe 8 times earnings, 12 times earnings, way below the overall market average. These companies pay dividends, real cash hitting your account every quarter. In 2026, some value stocks were yielding 4 or 5% annually. The appeal is simple. You're buying $1 of assets or earnings for maybe 60 or 70 cents. That's the discount you're hunting for. Value investing is what made Warren Buffett a billionaire. Buy great companies when they're temporarily unloved and wait for the market to recognize their worth. So when does value actually win? Historically, value stocks outperform during 3 specific market conditions. And we're seeing 2 of them right now in 2026. First, rising interest rates favor value. When rates climb, those future growth stock profits become less valuable today. Value stocks with current earnings look more attractive. Second, economic recovery periods. When the economy bounces back from recession, those beaten down value stocks in energy, finance, and manufacturing surge first. Third, periods of high inflation. Value companies can raise prices immediately to protect margins. Growth companies burning cash struggle to maintain their business models. Between 2022 and 2024, value crushed growth because we had all 3 conditions at once. Rates rose, inflation spiked, and the economy was uncertain. But in 2026, the pendulum swung back. Inflation cooled to 2.3%. The Federal Reserve cut rates twice. Suddenly, growth was back in fashion. Artificial intelligence stocks alone return an average of 47% through June 2026. Some individual names doubled or tripled. Meanwhile, traditional value sectors like utilities and consumer staples barely moved. Some actually lost money even as the broader market soared. Now, let's address the elephant in the room. Risk. Growth stocks can make you rich or wreck your portfolio. The volatility is not for the faint of heart. Remember the tech crash of early 2022? Growth stocks fell 60, 70, even 80%. Investors who bought at the top waited years just to break even. Growth stocks require a strong stomach and a long time horizon. If you panic and sell during the inevitable drops, you lock in massive losses. Value stocks feel safer. They don't swing as wildly, but that safety comes with a hidden cost: lower long-term returns. From 2010 to 2026, Growth stocks return an average of 13.2% annually. Value stocks, only 8.7%. That difference compounds dramatically. $100,000 in growth became over $700,000. The same in value, only $360,000. But here's what most YouTube finance channels won't tell you. The best investors own both. They're not mutually exclusive choices. Value provides stability and dividend income. Growth provides explosive upside potential. Together, they balance risk while maximizing returns. So what's the optimal split? That depends entirely on your age, risk tolerance, and time horizon. Let me break down 3 different strategies. If you're under 35 with 20+ years until retirement, you can afford to be aggressive. Consider 70% growth, 30% value. The volatility will be intense. But over 2 or 3 decades, growth stocks have historically delivered the highest returns. Time is your biggest advantage. Between 35 and 55, go balanced. 50% growth, 50% value. You get upside with protection against major crashes. This is where most investors should be. It captures enough growth to build wealth, while the value portion cushions the inevitable downturns. Over 55 and approaching retirement? Flip the script. 70% value, 30% growth. Preserve what you've built while maintaining some upside. Those dividends from value stocks can supplement your income. And you won't panic if growth stocks drop 30% because they're only part of your portfolio. One final insight for 2026 specifically. Watch the Federal Reserve policy meetings. If they signal more rate cuts, lean heavier into growth. If you found this valuable, smash that like button and subscribe to Operation Wealthy. We're building a community of smart investors who refuse to follow the herd. Your action step today is simple. Open your brokerage app and identify which stocks in your portfolio are growth versus value. Most people have never done this. Once you know what you own, you can make intentional decisions instead of accidentally ending up too concentrated in one category. Remember, there's no universally correct answer. Growth and value both have their place. The key is matching your strategy to your specific situation. Stop following generic advice. Build a portfolio that actually makes sense for your age, goals, and risk tolerance. That's how real wealth gets built.